In this episode, we discuss the 3 ways that practicing infinite banking can increase the return of every investment you can make. She's Holly, and she helps people find financial freedom.
He's Nate. He makes sense out of money. This is Dollars and Nonsense. If you follow the herd, you will be slaughtered.
All right, Holly. Well, it's great to be back. Great to be back here hosting a podcast, talking about things that we love to talk about, which is always fun. And this episode, we had an idea to talk about something I'm sure we've hit on, maybe these all individually as time has gone on, and episode in the 140s now. But we wanted to highlight how infinite banking itself helps you become a better investor, helps you increase the return or the profit of investments that we make. The reason why I think this topic is so important is because it's very common to have a misconception of what infinite banking is actually all about, right? And people can get kind of caught up in comparing infinite banking to some other form of investment, whether it's in the world of real estate or in the world of the stock market or gold and silver, all these different things. And so we're trying to get people to see it for what it really is, which is a banking tool that can help you with every investment that you can make, as opposed to an either or game. So to understand infinite banking, we have to kind of get out of the investment mentality. Thinking of the policy as an investment can really hinder your growth as an IBCer.
Well, and the policy is not an investment. It's like what Nate said, but you guys got to remember this is your system or what you're implementing in order to be able to create your own banking system or be able to go and invest and use this as the vehicle to put your money into and then take it out to invest in something else.
Right. Yeah. I mean, that's almost the way you ought to come into this, as seeing it. Like infinite banking itself is a tool in your hand to help you become more profitable, making money oftentimes in a new way. So maybe we should also state that, Holly, state that at the beginning too, that so often the only way that we have our money make money is when we invest it. We're never really taught how to make money financing an investment or financing a car or financing a mortgage or all these things that we teach people how to do. It is a totally new ballgame for most people. It takes a little while before our brain can compute, but it is making money in a different way, which is fun, but is new for most people. So we're going to focus on 3 ways that practicing this concept, the infinite banking concept, can increase the rate of return or the return overall as an investor, and certainly in each investment as well. So if we want to dive in, Holly, the first way that practicing the infinite banking concept can help increase the return of your investments is by allowing your money to grow in more places than just one place at a time. In other words, having your money grow in 2 places at the exact same time. And if you're a listener to the podcast, you've heard us say this, money doing multiple jobs, but what exactly do we mean by saying, hey, your money can do more than one thing, which will end up making you more money than if it just does the one thing that we're so used to it doing?
What happens is we take our money out of a bank account or somewhere that we have it stored, and we go and put it in that investment. And the only thing or only place that money is growing is inside the investment. When you're actually using the infinite banking concept and you're using your policy, it's growing, like we said, in 2 places. It's growing in your policy, even though you've taken the money out or borrowed from your policy. It is still growing in your policy while it's also being used for the investment and growing there as well. So you have it doing 2 places of work, basically. You have the interest that's accumulating inside the policy, and then you have the money you're making or generating from the investment.
Essentially, what we're kind of comparing it to is just the old way of doing things. So we've all made investments in various things before in life, and most of the time our money is just sitting idly on the sideline until it moves into the investment, because a bank account really is essentially doing nothing for us. What infinite banking allows us to do is take money and move it into a policy, which is an asset itself. And then we can leverage that asset to go purchase a second asset. So we've actually, let's say I put in $100,000 into a policy, and then I leverage $100,000 out of the policy to purchase rental property. I now actually have $100,000 of cash value in the policy, given it has been leveraged, but that $100,000 is still growing, earning interest and dividends, supporting a death benefit. It's still a valuable asset to own, while I've also leveraged it to go purchase a different asset, which will hopefully also be a profitable entity itself. So I actually have 2 profitable entities for the same $100,000 outlay of capital. What we hope everyone can grasp and picture about the infinite banking concept is that it's not an investment itself. It's actually a way to enhance everything else that we're doing so that you don't just have money doing one thing. I only have money invested here, here, and here, but you can actually be growing multiple assets at the same time.
What we're saying is your money is earning something all the time in both places, not just one entity. Most of us only have our money earning something in one item or all the multiple investments, but only those dollars in there are earning interest. We actually leave money on the table if we're not using the infinite banking concept, because basically, who wouldn't want your money compounding inside a policy while you're using it in an investment? That two things. I mean,
Yeah, I mean, this could have almost been a point in and of itself, but we're just going to incorporate it in point number one because we said we're going to do three ways. Let's leave it to three, but I'm going to throw in a little bonus one here. By using the infinite banking concept, you can also turn any asset into a compounded asset. And so what I mean by that is a lot of times if we want to invest money in something that produces cash flow, the problem with receiving that cash flow is that it's essentially a simple cash flow. In other words, it's not like a compounded asset itself. Now, maybe you own a property that is appreciating in value in a compounded way. And I'm not trying to disqualify that, but what I'm saying is the cash flow that it produces is technically simple interest. It's not actually compounded interest per se. In other words, if I put in $100,000 and I get 10% interest, then that thing's going to spit out $10,000 a year in cash flow. The problem is that 10,000 has to go someplace. Oftentimes it just kind of sits around and it doesn't do anything until we find a new place to put it. So essentially we're getting this cash flow, but if we can roll it back into a policy, now we're taking that same amount of cash flow, but putting it into a place where it can compound. So we can turn any, whether or not it's a compounding asset itself, or if it's just an asset that spits out income, like maybe like a loan asset. In other words, like if I lend money to somebody, I'm getting paid interest, but the asset itself is not compounding. But we can turn it into a compounded asset where I could receive this interest income from whatever this asset was that I purchased. And let's say it produces 10 grand a year for 10 years. So I've received $100,000 in interest from an investment. But since I rolled it into the policy, the cash value itself might be worth $150,000 at the end of that time frame. So I was able to turn a simple interest investment into a compounded investment simply by having the policy be the funding source. Having money do multiple jobs at the same time is such a huge game changer in the world of investing, to have two assets for the price of one. And the amazing thing is we can do that with essentially no risk because of how the life insurance policies themselves work. So we love that. The second thing we wanted to talk about, though, was in the realm of taxation, that not only can you have your money growing in multiple places at the same time, the same dollars, you are also, by using a policy as your funding source to make investments, you're going to allow additional tax deductions available. So how does that work, Holly? Getting additional tax deductions.
when you use the policy money, you take it out from there and then you go put it in investment or you give it to your business, you get to deduct that from your taxes. So by taking the money out of the policy and then going and investing it, you've decreased essentially your taxes. Or if you loan it to your business and the business is going to pay you interest, you also get to deduct that interest from your taxes. So you use the policy not just because it reduces your taxes, it's a bonus, right? It helps and it reduces it. That's not the only reason why you do it. But hey, could we ever do that in our regular without the infinite banking concept? No.
And that's a good point. We do want to make sure everyone understands that the whole reason is not exactly to get a tax deduction for the interest that we pay, but it is the cherry on the top. So in other words, I would do it just to have my money working in multiple places. But anytime you use a policy loan to fund a business expense or to fund an investment, any interest that is paid back to the policy loan is a tax deduction. It's not necessarily anything magical. That's just the way taxes work. In other words, if you borrowed money to make an investment, any interest that you pay on the loan you took is an expense that offsets any income that the asset produces. So that's whether you borrow money from a bank, whether you borrow money from a friend, whether you borrow money from a hard money lender, or whether you borrow money from an insurance company, the interest that you pay on a policy loan is a deduction. So what we love about that, though, is that the interest that I pay on a policy loan is a tax deduction to me, but yet the interest and dividends that the policy itself is earning that entire time is a tax-free interest and dividend. So I get to deduct the interest that I pay, but all the interest that is being earned, I don't have to claim at all. So not only can your money do multiple things at the same time, you can also, by using a policy as your investment source, you can increase the profit of any investment simply by the fact that the amount of taxes that you'll owe on the profits of that investment have been reduced because we got the money from a policy.
This is a system you want to put in place and you want to use it for business loans or investing because it only helps you. It doesn't hurt you now or in the long run. It actually benefits you to be able to reduce your taxes, to be able to make your money do more than one thing at the same time. So I think if you can grasp the fact that you can use this not only in your business, but as a way of investing, and then it helps you, it's a no-brainer not to go ahead and get started.
Absolutely. So let's say I go put $100,000 into an investment that earns 10% interest. And so I make a profit of $10,000. That's 100,000 at 10%. So I've got 100,000 invested. I'm going to earn $10,000 of interest. And let's say that in my state and federal tax bracket put together, I'm paying 40% in taxes. So if that's the case, maybe I'm in the 30% tax bracket paying, state taxes as well on this investment. So if I'm just investing out of pocket using cash, not using a policy loan or anything, I write a check for 100,000. I buy something that's going to produce $10,000 of interest. I owe taxes on that 10 grand of income, the interest income. And so if I'm in the 40% tax bracket, I've got to pay $4,000 to Uncle Sam. My 10% investment just went from making me $10,000 to making me essentially $6,000 because I had to give 4 grand of my 10,000 to the IRS. So my after-tax result is I made a profit of $6,000. Let's kind of compare that to what would have happened if I took that same 100,000 and borrowed it from my life insurance policy to fund the same investment that produced a 10% yield. The investment would still produce $10,000 of profit, but if my policy loan, and policy loans range, but let's just say, Holly, that it's at 5%. That means that I have to pay interest on the policy loan of $5,000. So I have 10 grand of profit from the investment that I earned in interest. I had to send 5,000 of that as interest back on the policy loan, which means I'm only being taxed on $5,000 because my profit is not 10 grand, it's only 5 grand because of the interest expense that I'm allowed to deduct from my taxes. So now, instead of owing $4,000 to Uncle Sam, on the previous example, now my profit's only 5 grand. And so 40% taxes on 5 grand of interest income is only $2,000 of taxes. So I went from paying 4 grand of taxes to 2 grand of taxes just by changing where I got the money to fund. Now, some people would say, well, Nate, what about the 5,000 of interest you paid? And that goes back to us having money doing multiple jobs, Holly. So in other words, if I have $100,000 of cash value, my policy probably grew by around, $4,500, $5,000, somewhere in that range. So if we're just kind of keeping it simple, then I now have $105,000 of cash value, and I've got essentially $3,000 of cash in my pocket. Maybe this would have been better on like a webinar, so I can actually show all these numbers out. I might be losing people. But essentially, what the end result of the cash investor was that he produced a $10,000 profit. He paid $4,000 in tax. He was left with $6,000. We have essentially, by using the policy, turned the profit from $6,000 to $8,000 in a very simple scenario by mainly reducing the amount owed to Uncle Sam. So that maybe got a bit more hairy than I was hoping, especially just for an audio podcast. But nonetheless, anytime you can reduce a tax burden, it's just sticking more money back in your pocket. And it really helps not only just reducing the tax burden, but also knowing that the interest that we pay on a policy loan, we essentially are going to end up recapturing, not in a direct way, but as the policy compounds on the full amount.
I think too, one of the keys here is people are like, but I had to pay $5,000. But remember, you're an owner in the bank. It wasn't $5,000 that went into somebody else's. You gave Bank of America, Wells Fargo, some other bank. It was money that you gave into your bank, the life insurance company of which you're a shareholder. So in some ways, you paid yourself back. I mean, you paid the policy loan interest due, but in reality, that's still profit to you. It's going to come back to you one way or the other. And so I think you have to see the bonus thereof, not just the $8,000 you capitalized, but at least you didn't give $5,000 over to a traditional bank of which you don't get any benefit because you're not a shareholder in that bank. And at least by paying the life insurance company the interest, you get the benefit of being a shareholder and reaping dividends that are paid out to you.
Yeah, and honestly, I don't know if we'll be able to do it justice to everything that's going on, Holly. So I hope we didn't open up a can of worms and then say, "Oh, we're not going to close it today." Good luck, listeners. But maybe we'll have to do a follow-up, episode just on how policy loans work, how loan interest gets accounted for, how much policies are growing by alongside of it, and so forth. But all that to be said, the fact that the IRS is essentially going to supplement the loan interest that you pay back on a policy loan, but yet they do not tax you on the growth of the policy internally, it pretty much guarantees you're going to come out ahead every single time. So we love doing that. It just adds to the benefit of funding your investments from policies. And then the last one, so first one we've got by using policies to fund investments, you automatically have two assets for the price of one. We love that. You have your money growing in multiple places. The second one was you'll be able to increase your tax deductions, or essentially we could reverse that and say you'll be able to decrease your taxes every time you use a policy to fund an investment compared to what we would have had to pay in taxes if we hadn't used the policy. So those are the first two. The last one, and this is one that maybe is not exactly tangible per se, but it's something that I know to be true in my life and in many of my clients' lives, is that by practicing the infinite banking concept, it allows you to become more opportunistic on what you choose to invest in. And so, because my money is growing guaranteed with absolutely no risk and no tax inside of a policy, it allows me to not have to so easily get my ears tickled by investors who are trying to raise my money, but it allows me to be very opportunistic and only choose to invest in things that I really believe in and that have a very high likelihood of success because I'm not desperate to find a place to put money. And I'm not just putting things in money by default, which is what most people with retirement programs and things are already doing. They don't know where else to put money. So they're just throwing money in it, even if they don't want to be a part of it. I do believe that by practicing infinite banking, it allows us to be more opportunistic in what we choose to put our money into.
Is the money in your bank account losing value instead of growing? Are inflation and taxes going to get better or worse? Conventional banking makes the bank rich using your money and pays you little to nothing in return. We believe in challenging the status quo. After all, most of those conventional tools only seem to make someone else rich. Let us show you how to beat the banks and inflation. Visit livingwealth.com/beat inflation. You'll receive instant access to what we call the beginner's course. This in depth and easy to follow course teaches people how to create and profit from infinite banking. You can become debt free, in control, and achieve financial security and significance. Stop letting the banks and Wall Street dictate your financial future. Go to livingwealth.com/beat inflation today to instantly receive free, no obligation access to this priceless course on infinite banking. Again, that's livingwealth.com/beat inflation. Now back to Nate and Holly.
You want to be able to pick and choose where you want to invest your money and not feel like your only option is the stock market because that's all you know, or it seems easier to do. You actually can literally decide, yes, this is an investment I want to take, or no, it's not, because your money is going to keep growing in the policy, but it allows you the opportunity to, number one, and we've said this a lot, Nate, to find something you're passionate about or that interests you, but also not to have to take a lot of risk with your investment, but be able to choose that's something I do want to invest in and take the time to look at it and see whether you want to invest or not. And you're not pressured. In reality, I've never felt pressured to go into an investment because of my policy. Like I can pass on that if I want to, and I'm okay.
It's almost hard to put it into words. I just speak from personal experience. I got the one life that I live. And there's just something powerful about having money that's just guaranteed to get bigger every single year. There's no risk of it losing value. I can't do anything to stop it. It's just the money's just it's accumulating interest, and there's nothing I can do to stop it from happening. And there's just something powerful about that if I have a big pool of money that's growing consistently without any risk, and I can access all of it anytime I want to take advantage of opportunities, it allows you to kind of invest with some confidence is really the only way I can put it. I don't ever feel pressured to put money to work anywhere because my money's always working. It is always working at a very good level. So that means I don't really have to try to squeeze money into an investment that I really have no reason to be getting involved with, other than I just have money eating a hole in my pocket, which I think is what drives some people to make investments in things they probably shouldn't be investing in. Maybe it'll work out for them. I'm just saying that they're not totally sure. That's not really a place that they understand or know anything about, but they just know that they've got money doing nothing and they've got to put it to work. I love how infinite banking never puts me in that position. I never have to make bad decisions on what to invest in. I still make mistakes, Holly. At least they're calculated risks.
Even with a calculated risk, Nate, because your money is back to point number one, but because your money's doing two things, you're not at a loss because that money was so compounding or growing in the policy, as much as if you'd put it all in and it was a calculated risk and you lost it all. You don't have any compounding or anything taking place if you didn't take it out as a policy loan. You just took it out of your bank account. Now it's gone. You got to recreate or regenerate that wealth that you lost, that money that you lost. And I think that that's when we say it gives you the opportunity to be picky. It does give you that freedom to truly understand, even if something went south, Nate, and you lost some money, it still was growing inside the policy tax free, which I'll take any day, even over a loss, right? Because at least my money was doing more than one thing and not all the money's gone.
Yeah, if you invest money that hasn't hit a policy limit, that hasn't entered a policy yet, and the investment goes south, you just lose money and you have nothing to show for it. Whereas anytime you're able to have money enter a policy first and then borrow it out to invest, the investment may go south, but you're actually still able to receive some value from owning the life insurance policy itself, even though the investment may not have turned out to be what we had hoped it would be. Maybe it's underperforming, or maybe it's actually losing money. One term I've heard that I really liked as well, Holly, is that there's a difference between a return on investment and return on equity. What this means is by using infinite banking, by having your money grow in multiple places and reducing your taxes, you can actually get a better rate of return on your investments than you could otherwise. But there's another element to this that I think gets lost sometimes, and that is the idea of return on equity. In other words, if somebody is worth $1 million, it's very rare for someone who's worth $1 million to have 100% of his assets invested in various things at any given point in time. They may have 400 or 500,000 invested in real estate, a few hundred thousand in stocks, but money will be moving around in and out of those investments, and there's typically money sitting around in cash that's waiting to be invested. And for most people, the money that's sitting around in cash, their own capital that's just not doing anything, they may be able to find great investments and have good rates of return inside those investments, but their return on equity, the return on capital, how much their overall wealth is growing as a picture of their entire investable asset portfolio, may be not really doing that well because they have idle money that's doing very little to nothing, which is very common on most people. So one thing we love about, or I personally love about practicing the banking in my own life, is that while I do love that IBC helps me increase the rate of return of an investment, it also really helps me make sure that I'm getting a return on 100% of my assets at all times, that I'm not leaving money that I could have made on the table. My return on equity, there's a minimum level of return on all my equity at all times. And I know that may be difficult to grasp, as I said, over just like an audio podcast, and maybe I'll have to do a video on it. But nonetheless, we truly do believe for the vast majority of time, there's not much of a downside to investing using a policy. It really does complement it so well that we really believe everyone should be practicing the infinite banking concept in this way.
I haven't come across a downside other than in reality, it takes discipline and you have to live within your means to actually utilize your infinite banking system. And if you can't do those two things, I guess that is the downside that it's a system that won't work for you because you can't spend more money than you make with this system.
There is some legitimate downsides per se. They just pale in comparison to the upsides. So, I mean, obviously, it's not a get rich quick scheme. Early on in the life of life insurance policy, you don't even have 100% available to use of what you've paid inside the policy and premium. So it's not a fast starter. It takes some capital to get things moving, and I mean, we could go on and on. I'm not trying to hide those facts. I'm just simply saying that it is true that we can really increase the rate of return in your life, in your investments, and to have money do multiple things in a really brilliant way with very little to no downside. And the downsides are very well known at the beginning. In other words, there's nothing really that can come in and attack it from outside per se. Hey, we all know what we're dealing with, and it's almost like clockwork. We just know what we're dealing with, and we know how to function with it, and it works exactly the way it's supposed to work. So these are all the things we love about infinite banking. Well, I guess I'll recap then. The three main ways IBC helps you become more profitable in your investments. Number one is it allows money to grow in multiple places with the same dollars. I can put $100,000 into a policy, borrow $100,000 out of the policy to buy an investment. And now I've got value inside my policy and value inside my asset with the same exact money without having to put in any extra money. Number two is that it allows us to reduce taxes by using policy loans to fund investments. Anytime we can lower a tax bill, we're able to keep more money in our pocket, especially when we can essentially recapture any interest that we pay through the growth and compounding of a policy on a tax-free basis. And then lastly, it allows us to be more opportunistic when we make investments because we know for a fact that all of our money is going to continue to grow very competitively, whether or not we leverage it or not. So it allows us to be a little bit more opportunistic. We can be more picky. We can find only the best deals, and it increases our return overall on all of the assets we have because all of our assets can be working at all times. It's been great having you on the show, Holly. Thanks for joining us, everybody else as well. This has been Dollars and Nonsense. If you follow the herd, you will get slaughtered.
For free transcripts and resources, please visit livingwealth.com/E144.
Listeners, one last thing before you go. Start your journey towards financial security and wealth today. Visit livingwealth.com/beatinflation. You'll gain instant free access to the beginner's course Ray, Nate, and Holly made just for you. Again, that's livingwealth.com/beatinflation.